Yeah, welcome back to the channel. Allow me some additional remarks again for concerning the international or national inheritance tax. This is now part number 5. We still speak about the German inheritance tax law and here about the rules concerning the objective tax liability, so concerning the events which are taxable. And 2 out of 4 possible events are still left over. These are the special purpose transfers and the family foundations. So we are here yet, and here you see 1 number 3. One of the occasions which triggers taxation is special purpose transfers. Well, what is now a special purpose transfer? Let me explain best by an example. Especially as you know, as you probably remember from the last lectures, you can appoint everybody in principle as your heir in your last will and testament. Now, that raises questions. Where are the limits? Can I, for example, appoint my dog as my heir? And now, surprisingly, we can appoint everybody as heir or heiress, but it must be an everybody. So the answer is no, because a dog is not a person. And only persons can hold rights and obligations under civil law. Now, as a dog doesn't qualify as a person, a dog cannot become the owner of all your property. So it's not possible to pass over ownership of all which you possess to your dog. The nearest approach which you can do if you want that your dog profits from all what you have is you might appoint some honest fellow as an heir and impose on that person in your testament the condition that not a single penny of your money may be used for that person, but that all the money is only for the usage of the dog. So that all the money must be spent in the best interest of the dog for health treatment, holidays, security guards, and whatever might be regarded as necessary for a good life of that dog. So the person who gets the property just has to documentate the usage of every single penny in order to prove later that the money was not embezzled. Now, that would be possible. In such a constellation, that person would become the legal owner of all your possessions, but would be bound by the conditions not to make use of that property in his or her own interest, but would have to prove that every money which was ever touched was used for the dog's purposes. So in that case, that person would get all your wealth, but you could not say that person has been enriched by this inheritance, because this heir or heiress is absolutely not allowed to have any advantage from the property. The money has instead completely to be used for the specific purpose laid down in the testament. Everything has to be spent for the dog only. That means the heir is not enriched. The money, on the other hand, does not end up in the hands of any other person, as in case of a legacy, but it has to be spent for that special purpose. So the only thing or so which you could say is enriched by that transaction is that special purpose. Here, the solution of the law is then, okay, then we regard that special person as a kind of independent entity, as a kind of quasi-juridical person, and we say the special purpose property which has now been created is subjected to inheritance tax. And that is what is meant by a special purpose transfer. Zweckzuwendung in German. Yeah? A transfer of money or property which can only be used for a specified purpose and not by the person who holds the official ownership. So it's a kind of a separate mass of property separated from the official owner's own sphere of property and therefore an independent economic entity. So that will be then taxed as something different. In accordance with what I explained to you, you can find a definition naturally of a special purpose transfer also in the Legal Rules 8 of the Inheritance Tax Act in Germany. Gives us a definition and says special purpose transfers are transfers of property either on grounds of death or donations among living persons, which are connected with the condition that they have to be used for a special purpose, so not for the sake of the owner, or which are subject to their use for a certain purpose as far as this condition lowers the enrichment of the acquirer. So as far as this condition effectively hinders an enrichment of the acquirer. So condition for a special purpose transfer property would always be the person officially acquiring it can make no use of it. Then a special purpose transfer or special purpose property becomes to exist. Okay, after this, naturally, the next thing comes. You see here in 1.1 the list of the taxable events. This number 4 is not really an event. We mentioned that already. The property of a foundation, if that foundation has been established in the interest of a specific family or several families, will be taxed in periods of 30 years again and again, as if somebody had died and the property had again received or the money. So as if the one foundation had died and had left everything to a new foundation. The background of this is when you tax this when you do this 30-year thing, the background is why is it necessary? A very widespread trick of former decades was that you transfer all your property to a foundation. Now a foundation is a mass of property or a juridical person which has to use its property according to commands which are written down in its statutes. So you could then write into the statutes of that foundation that the foundation is allowed and obliged to only use its income to support financially the family members of the founder and their descendants. So the family and all the future members of the family till eternity ends, or the foundation goes bankrupt, whatever comes first. So the idea is then, by such a construction, your family members get the income which can be achieved by the foundation, and so their financial position is not really different from the position which they would have if they had inherited the property itself, because the income ends up in their hands. Now the only difference is probably that the family members do not own the property or the capital itself, so they cannot touch the capital, only the income. But on the other hand, that can be seen as an advantage. If I choose this model, then my family members cannot waste the capital and make themselves and my grandchildren and great-grandchildren poor. They can only touch the income, so the value of the property can probably be kept up. I could even set some conditions that a part of the income has to be used to counterattack inflation or to maintain the value of the capital and so on. But in principle is they can spend income, and if they were clever people who would not waste the capital and restrict themselves to spending the income which comes in currently, there would be simply no difference at all in the future financial situation of my family. Now, the one important difference would be my family members, if they had inherited my property, would die from time to time. Generation after generation would fall down dead and be buried, and with them part and part and part of my property would go as inheritance tax to the fisc. Now, the advantage of such a foundation model is the foundation never dies. You know, that's my dream of the next James Bond movie, Foundations Never Die. That sounds so great. And indeed, it would be great, because once you transfer your money to the foundation, that's a donation, causes inheritance tax, and then that's it. Never again. Foundation never dies. So that would be, again, an idiot-proof model to save taxes, if you are rich especially. Because when you are very, very super rich, it is, let's say, clear and foreseeable that your heirs never need to touch the capital itself in order to live a very luxurious life. So to impose on them the restriction that they only can touch the income, or that they get their income only from the foundation when the foundation distributes its income to the entitled family members, that would make no difference for them, but the inheritance tax would never be paid again. And especially for the super rich, this would be a very attractive model. Not for you and me if we only own a small car and a small house, because our heirs would probably like to spend the money and to touch the capital. So that model was regarded as a bit unfair or as a loophole, and it became more and more frequent as a loophole. So the fiscal ministry in Germany began to react to that as late as 1974. They introduced this rule: if a family foundation holds property, then there is the fiction that this family foundation has to pay inheritance tax on the current state of its property every 30 years. That is a rough estimate for the duration of a generation. The idea is, in nature, there an owner of property would probably die away every 30 years, so that in real life, every 30 years in average, inheritance tax would become due, and so a family foundation shall be subjected to inheritance tax in the same frequency. By this way, the tax advantage which results from the underlying idea is mostly removed. If it's really still an advantage left over or not, that depends a bit on in which, let's say, distance between the generations my family members really intend to die. That's not foreseeable, so 30 years is a good estimate. Yeah. Now, naturally, such a foundation gets rid of a huge amount of its money every 30 years, and now if they have to distribute their income in the meantime, probably that ends up in that the capital goes down more and more. So one gave these family foundations an option to opt for paying the inheritance tax payments in 30 equal installments. So they can probably say, if they have an income of 100,000 annually and need 10,000 or 20,000 for each year's inheritance tax installment, then they can probably justify only to distribute the rest, so that their capital amount can be preserved. That is an idea which I can imagine as background of such an option. Yeah, here you find even that rule in paragraph 24 of the Inheritance Tax Act in Germany. So in the last part where strange and special arrangements are regulated. So here you see this option in case of number 4, family foundations and private associations erected in the interest of a family. The taxpayer may demand that the tax can be paid, one word is missing, paid in 30 equal installments. And the total of the installments includes then the payments and the interest. And the interest calculation is to be based on legally fixed interest rate of 5.5%, irrespective of what is realistic in the market. Now, if you want to calculate then how high such an installment is, you can take refuge to a supplement in the valuation law. There is a supplement 9a. This gives the capital factor by which a sequence of equal payments can be transformed into its present value. And for a period of 30 years and an interest rate of 5.5%, that factor is 14.933. And now when you have the equation or the information, the amount of the inheritance tax is 14.933 times 1 equal installment, which is paid over 30 years. That this is the present value. Then you can transform the equation the other way around and can find out the value of one installment, because then one installment is the amount of the inheritance tax which is due under the law divided by 14.933. Okay, enough for today. Short remarks on these two parts of the objective tax liability part of the law, and we probably have to go on with some remarks on the personal tax liability, but that will come in another video, probably soon or sooner or later. Just let yourself be surprised. Okay, thanks for watching. Till next time, goodbye.